Hello, good morning, and welcome. So, after the exciting panel from earlier on, I'm going to have to pull out something a bit more mundane, nevertheless not less contentious, called valuation in venture capital. So we have a fantastic panel lined up, and I will introduce my panelists in a second. The panel is very much anchored on a fantastic report we recently published together with Jada Fund of Funds called Valuation, Venture Capital Valuation in MENA, a reality check. It gives you already an idea that this is not an easy conversation. Nevertheless, valuation is obviously the most important part. That's where it all comes out and where all the fund managers behind me show whether they had basically done the work that they promised to their LPs. We basically had an interesting conversation in the report. The report has been widely read globally, and particularly what we highlighted is that venture capital is a different risk profile, requires a different risk appetite than private equity. So, with no further ado, we will come to the various methods that were being used in conversation with my wonderful panel. So on that note, let me briefly introduce myself. My name is Claudia Zeisberger. I'm a professor for private equity and venture capital at INSEAD, based between Paris and Singapore, with regular stopovers here in Riyadh in the last 4 years. So on that note, I shall take a seat and invite my panel to have conversations with us. Let me basically, before I kick off, invite all the fund managers in the room to reach out to me afterwards, and there's a good reason. Whilst this was an initial report that INSEAD did in collaboration with Jada Fund of Funds, we had yesterday just worked out our roadmap for the next 18 months in terms of research. In that context, obviously, we want to hear from all the fund managers. We also want to hear from all the investors in venture capital. What would you like us to focus on? So please do reach out to me or to any of the panelists here. So without much further ado, thank you very much for coming. And let me start off with Waleed Alballaa, who is general partner at Sukna Ventures. And you were one of the first VCs that we interviewed for the report. So I appreciate it.
Thank you.
And thank you for your time.
Thank you.
Now, when we spoke, you mentioned that VC valuation is more art than science. And I would agree on that. How do you balance the subjectivity with the objectivity of obviously working with startups and seeing them quite regularly evolve and develop? So what basically differs in MENA from the rest of the world, if anything? Right. Please.
Thank you. So I think that subjectivity is a necessary evil. We want to be as scientific as possible, as objective as possible. At the end of the day, valuation is really an exercise to capture what is the willingness of the market to pay for future cash flow that the company will be generating. And when you think about it, there are two components to it. You're thinking about the intrinsic value of the existing business, right? And then there's a real option component where you're trying to see what kind of new streams will be coming in and how do you value those as well. And the real option is where there's lots of subjectivity, lots of estimates. The margin of error is really huge. And when you talk about VC specifically and startups, the intrinsic value in the beginning is negligible, right? There are almost no streams of revenue established yet, especially in the early stage. So the second component, the real option component, this is where the art comes out, and you try and estimate and break down where the future cash flows are going to be coming from, how is the market going to allow for it, what kind of ceiling will be put on it, what kind of moats will be built around it. And they're all attempts to estimate that potential going into the future. And if you think about it, for every startup, the real sources of cash flow are determined by three basically components as well. You have the market. So the market will tell you how big this value pool is, how much you can actually extract from that value pool. A good team, a great startup in a small market will not be able to benefit a lot from it, so the valuation will be much lower. You also want to see the structure of that market, how fragmented it is, or is it centralized, is it monopolized? Are there any structural barriers to entry, to scale? What kind of adjacencies around that market? There's so many factors that come under the umbrella of the market. It becomes one of the most important factors to consider in VC for early stage, because there's nothing else that is clear besides the market. Then looking at the team, looking at the technology, looking at the thesis that they want to do, the playbook they want to apply, you can start determining, well, how much market share will they get from that market? And from that market share, how much margin of profit are they going to be generating? And that will shape the cash flow that's coming in. Now, imagine that cash flow over 7, 6, 8 years, and then you see competition coming in and impacting that cash flow, pushing down your profits. You're going to have to sell at lower prices and so on. And this is all scenario planning that you're trying to do, and imagining what kind of scenarios will play out for the specific company and determining the cash flow. And as you can already see, it's getting very complicated, very complex. And in fact, during the interview, I showed you a catalog of what kind of factors we're looking in. And it's really huge catalog.
And it was a catalog, yes.
Yeah, what kind of factors, what kind of questions. And really, if you try and ask all those questions, you're overcomplicating it, and you're not giving the necessary weight to the real factors that will determine the success and the value of this company. So the art component here comes to, well, what are the 4 or 5 factors or questions I need to pick for this specific opportunity, and do the evaluations based on them. And then once you do that, and once you imagine where is the right bucket, where's the right categorization for this opportunity, another factor of error that comes in, and for many VCs, is they use what's called comps valuation. So, okay, now we know this is the company, this is the market, this is the category. How do I compare it to other companies already in the public sector market, for example?
Which again is complicated in an emerging market, right?
And even, if you look at the valuation ratios for Netflix, for example, you'll see it's very different depending on which ratio you want to look at. So even the market doesn't always, standardize on a single thing. But even, let's say, if you got that right, then you need to apply some kind of discounts and premiums, because the moats will be different, the growth rate will be different, lots of other different factors. So it's not really apples to apples, but you try to normalize as much as possible. And there's a famous saying by Michael Mauboussin from Morgan Stanley, and says, you have to earn the right to use comps, because you can mess it up very quickly. Having said all of that, this is the art part. I also want to emphasize, when you go a little bit higher to the portfolio side, the portfolio level, it becomes much more scientific. All
Sure.
that noise gets, neutralized a little bit, because now you have much more data in terms of what are the survival rate for the types of companies you want to invest in, what are the exit values, what are the dynamics in play. So sizing up your bets, sizing up what kind of ownership you want, how many companies you want in that portfolio, which sectors you want to invest in, what stage you want to invest in. I think that is more scientific than art there. So if you do that, if you do your homework at the portfolio level, then all that noise at the company level is manageable, because you're going to have, at least 20, maybe 40 shots where you can take more risk and go to more noisy places, as long as the upside is much higher.
Yeah. So let me come to the only LP on the panel. So Rasha.
Yeah.
Rasha Al-Saga is Senior Vice President as Jada Fund of Funds. So transparency in valuation reporting, obviously in the interest of every LP.
Yeah.
And as an LP invested in funds globally, so what are your top challenges to deal with to bring it all down to a common denominator?
Okay. Thank you for having me in this panel. So I think the valuation is a very critical aspect of any investment, of which, let's say, deals we either make or break. And maybe the three key challenges are the discrepancies in valuation. We've seen same portfolio company being evaluated differently. For example, some fund managers would use post-money valuation based on qualified round, where others might use convertible note cap. Some would even rely on valuation on term sheets that are not signed already. So I think this is the first and main challenge on valuation. The second one is having inconsistent approach on marking up investments. So they either do more frequent markups and less frequent markdowns. And the third one, I would say, is more on transparency of the models used. Sometimes there might not be sufficient information provided on the models used, the assumptions, for example, the round size, the valuation of the round. So I think these are the three key challenges that we've seen in the past couple of years.
And do you see the needle moving in the right direction? So is your sense that it's getting better?
Yeah. So
Yes.
actually, we've seen this a lot. We've seen more standardized methodologies being used in order to, let's say, enhance comparability and more being transparent. We're seeing also more reports provided to LPs, showing them some successes, some challenges, key trends, and also red flags.
Very good. So let me jump to Michael. Michael, founding partner of Golden Gate Ventures. You recently raised a fund out for the GCC.
Yeah.
You're right now based on a plane, as we discussed earlier on, but you're based in the region. Cross-border. Let's have a conversation around that, because you've been very prominent for a long time as Golden Gate in Asia. You've seen one ecosystem basically develop very, very fast as well.
Yeah.
Cross-border growth. So when investing in startups that plan to scale out of their home market, how do you assess their potential? Because that will be, to some extent, a story to be told for the whole region here as well.
Absolutely, and thank you for inviting me to the panel as well. It's an honor to be here. I'd say cross-border is one of the most difficult discussions with founders, with investors I've ever had, and been doing this for 14 years. So to give one example, we had about 9 years ago, one of the major payment gateways out of the US expanding to Southeast Asia. And our first conversation was, where do you want to land? And the founder asked, what does it matter? Where do we land? I said, well, if you're in Singapore or in Jakarta or in Ho Chi Minh City, it's a world of difference. Apart from language or regulation, just the way that your product looks and feels and the way it's used is going to be very, very different. I remember, and I'm a bit older, so I can say this, I can remember when Evernote came to Indonesia for the first time. And when they were selling their product, they had to use scratch cards instead of credit cards or bank transfers, because no one had either a bank account or a credit card. So the way that you position your product is very, very important. What we're trying to build with our fund, now expanding to the MENA region, is helping our Southeast Asia portfolio expand here. And we've had about 9 companies doing this organically. And I always want to say that you can't force it. You have to spend a decent amount of time as a founder and as a company to really explore the market, understand local dynamics, understand what your product's going to look like, and why are you here? Is it purely on, I want to have an outpost here because I think it makes sense? I want to be here as a hub to jump into another region. I think what a lot of people are underestimating is we're seeing companies from all over the globe expanding here because they want to service the African market as well, and want to be based out of a mature market and go into a frontier market. So there's different ways of looking at cross-border expansion. I think what is always helpful is have someone on your cap table that has lived the story, that has been through it, and it can sort of help you navigate how to expand.
And obviously, regulation plays a role as well. So in the different jurisdictions where you are arriving.
Yeah, maybe as a quick comment, coming from Singapore, where regulation is a very important item. Um, in my first journeys here, very pleasantly surprised that from a government to government perspective, there's a lot of conversation between the different governments on how to improve and make regulation more efficient. So I see a lot of optimism from a regulation standpoint.
which would be important because in Southeast Asia, we have not seen that over the last decade, that the regulations are converging. So it would be good to have a region that is somehow aligned with regards to regulation.
Oh,
would make
absolutely.
life easier for the startups,
Absolutely.
right?
Yeah.
So now let me jump back to Waleed. So Sukna is heavily focused on MENA.
Sure.
You do Egypt as well, but you also go abroad.
Yeah.
Have some comments on what you see in the different pockets on where you're operating. So any thoughts in terms of startups, in terms of deal pipeline, what the difference is?
Right. So we focus on MENA as a market, not necessarily investing in MENA startups. The reason is we want to make sure that we can add value to our portfolio companies, whether they're based in MENA or beyond. And this is where we have our network, we have our knowledge, we can actually add tangible value to them. And that's why we want to be a valuable member of the cap table in each of those portfolio companies. Having to deal with multiple markets and multiple jurisdictions, we do see a lot of differences. Because we're in this part of the world where there's lots of attributes that are different than, say, the US market or European and Chinese. One of them is it's highly fragmented. It's highly diverse in terms of economies, purchasing power, regulatory stance, and so on. Our real focus on investments is, can the startup go global or not? So that simplifies things for us a lot. And I'll give you an example. We're one of the few VCs who are still bullish on Egypt, despite the economic situation there. It's because we believe in the Egyptian founders. There's lots of good talent there that can actually go global, and we've already seen that with a few of our portfolio companies. And we will continue investing in Egypt with that kind of view. And even in a market like Saudi, where the economy is strong, demographics are favorable, and everything is much better than most other MENA countries, it's not enough for us. All of MENA GDP is 6% worldwide GDP, whereas in the US it's nearing about 30%. And that 6% is very fragmented. So even in companies that we invest in that want to build in Saudi, we want to make sure that the founders actually have that global mentality, that they can have a TAM that is worldwide, not limited to a market. Having said that, we are also very selective in terms of which sectors we want to invest in and which parts of the value chain in each sector we want to play in. Say, for example, the gaming sector here in Saudi. It's well known that the Saudi gamer is one of the highest paying, per capita ARPUs around the world, even higher than the Japanese. And yet, if you look at the supply side, in terms of startups, we don't have any really strong gaming publishers or gaming studios yet, despite all the encouragement from regulation, despite the high demand, despite all the other favorable environment. And our wedge into the sector, we look at the value chain and we say, okay, maybe the studios and publishers are not ready yet for VC, but maybe there are some tech players that in that value chain that we can invest in today and they can go global. So, for example, we invested in Elevatex out of Dubai, where they provide AI for in-app purchase optimization. And they've seen already demand from companies around the world, whether it's Voodoo, Supercell, and others, all out of Dubai. So I think this mentality could have not been practical maybe 5-10 years, but what happened in terms of regulation, deregulation, I should say, and also the democratization of technology, thanks to the advances happening in the software side, you don't really need to live in a major hub, let's say SF, Silicon Valley, London, Berlin, or other places to actually build a global company today. In many cases, you can build it anywhere. And that opened up the market for us a lot and allowed us to take risks and bets on founders in those regions where the valuations are much more favorable and we get less competition from the big players. And yet we get to achieve the kind of returns our LPs also want.
So, I mean, the cross-border conversation is a big one amongst LPs as well, right? How do you actually execute on that? It's all a good idea, but execution is really, really important to implement it, and finding funds that can actually do so is very interesting. Rasha, I'm a big, I do a lot of work on ecosystems, and obviously, especially when we are in a market that is emerging fast, as was mentioned early on, but still emerging, building an ecosystem is really crucial, especially the space we're talking about, venture capital. All our startups at one point will raise future rounds, so we will need to start looking at valuations as well, as they are starting to raise from growth funds and later on from private equity funds. So the valuation gap between early stage and late stage, and you're an experienced investor, you have been in this for more than a decade. From your experience, what are some of the key differences you observe between the valuation methods used in early stage versus valuation method of later stage funds?
Yeah, sure. So I think the difference between early stage and later stage funds are significant given the maturity and the nature of the underlying investments. For early stage, it relies more on subjectivity. So given that less available data, so they're going to rely more on, for example, market potential, expected growth, and other qualitative assessment, such as for example, the quality of the team, the market product fit, and maybe other qualitative, as I said, assessment. On the later stage, they relies more on financial metrics such as profitability, operational sufficiencies and efficiencies, and maybe the later you go on the life cycle of the business, the less subjectivity there. Yeah.
And
Can I?
Go ahead.
I was just going to add something, maybe a claim, or playing the devil's advocate here. I think with the dominance today of intangibles, actually is the final nail in the coffin of accounting. And it's messing up DCFs all over the world. If you look at the top companies in the US stock market, let's say NVIDIA, can you tell me today if NVIDIA is overvalued or undervalued? A $3 trillion company. No one knows if it's actually overvalued or undervalued because we're dealing with lots of unknowns here. Is the transformer model actually going to continue as the main model for AI, where GPUs make sense? Or are we going to find other models where NVIDIA actually isn't the best player? If the transformer model is going to continue, is anyone going to be able to replace CUDA, the software part of NVIDIA, or not? So I think there's a bigger issue at play here. The software and digital dominance of businesses today, the digitization of the economy, is doing this not just for the early stage, but even at very later stages. But it's just that the investors haven't realized it completely yet, and it will happen there. Maybe we're seeing it very early in early stages, but when I look at the comps, I have to wonder, how do they value those companies? Can I actually trust the comps, I'm saying the public market, to go back and, backwards and value my own early
Yet
stage
can you afford not to be invested?
That's
right?
the dilemma,
So that's the dilemma that you're facing right now. And maybe we're rewriting the way things need to be valued, right? I mean, if I have a slide in my class that shows the companies that are the top 10 by market cap. And I have this slide for the last 15 years. And I change, update it like every 6 months. And I look at which companies were invested by VC. And I can tell you right now, out of 10 companies that are on that slide, 9 are invested by VC. And the only one that is not is Aramco. So, and this has changed dramatically. We didn't see that 15 years ago, right? So again, the early stage part, and it will remain a challenge for the LPs as well, because you, out of all people, have to make valuations, kind of bring it all together from different funds, from different stages of maturity, and then we can overlay the public markets on top of that too, but we leave that for another panel. So let me jump to Michael. Let's talk about adaptation of valuation models across region. So because you're a player in those various regions, how do you do that? Or how do you even intellectually, how do you think about that? and maybe any examples that you may have.
Yeah, I would say in terms of our valuation method, we didn't have to adapt very much. But I can name a few examples of what we've learned over the past decades. If you go back, let's say 9 years, and you would look at Indonesia, if you were a payment gateway with an Indonesian founder going after the Indonesian market, any investor in the region would give you a premium. Without seeing the product, without seeing the traction, you're in Indonesia, you're a fintech company, you're a payment gateway, we'll give you a premium. Luckily, that's over. We don't do this anymore. But it has been helpful to really understand what drives these valuations. I think one of the other things that we've always seen was who is validating this company? So who's on your cap table? Who has done the work in terms of due diligence? Who's opening up the right networks for these companies to expand? We're seeing some similarities here as well. As we are, of course, now deploying capital here, you are asking the same questions in terms of, okay, which markets are you in? Who has validated your previous round and decided to put capital in? Who's active on your cap table? Who's working with the founders in helping you expand, whether it's cross-border or staying within market? So those dynamics are very, very similar between Southeast Asia and here. What we saw in 2017 to 2019 was the influx of hedge funds and private equity capital at the early stage. I think that dynamic was in a sense disruptive and something we haven't seen here as much, of course, but I think in that era in Southeast Asia, it disrupted the valuation methods.
Very much so.
Because all of a sudden you had someone from the public market saying, this company is valued at 100 times revenue. Who are we to say that they're wrong? So what you saw was the method of valuation shifted all of a sudden. We're now back to normal because of where the market is. So we've seen different shifts initially it was your geography that tells you and your sector tells you what your valuation markup is going to be. Then it was more around who's on the cap table, who's helping the founder, who's helping you expand. And then all of a sudden we had these big giant funds coming to the market and sort of driving valuation. I think that is normalized across both Southeast Asia and definitely here as well. I think what we're seeing now in both markets, which is very interesting, is we're seeing valuation challenges where you fast forward a company 10 years and you ask more questions. Okay, you're telling us that you want to be a public company in the next 8 years. Looking at public market comps, I'm not sure if those are making sense for the business that you're in. So you were asking a lot of different questions at this point in time, which I think creates a more healthy kind of valuation perspective. So I'm seeing a lot of similarities between Southeast Asia and the MENA region in that sense.
Okay. Waleed, when we first spoke many months ago, you talked about the MENA discount. So tell us a little bit, what do you see? How do you think about it? Is it justified? I could turn it around, having spoken about excess valuations, right? Is this the reality? I mean, should investors realize that this is a way to get in now before we see this discount turn into a premium?
Yes, the infamous MENA discount. I think sometimes it's abused and misused by VCs when negotiating with the founders because at the end of the day, when you have the comp, you have multiple factors to discount or even add premiums to the comp, and MENA discount is just one of them. So initially, I learned about it in 2018 when I heard about the 25% discount and then tried to uncover where did that number actually come from. And it's just an arbitrary number assigned to this. And yes, I agree with you. It has to be treated in a more methodical way, more systematic way. But the basic idea, the premise behind it makes sense. The US market is very different than any other market in the world. So I can't take a comp from there and apply it to this market. The markets are very different. It will impact the cash flow of that company. A company selling into the US market will have very different cash flow profile than the one in MENA or even China, Europe, or other places. So there will be some normalization applied. And usually that normalization is to downwards in terms of discounting the startup because there's fragmentation in the market, there's some friction, regulation is not perhaps like in the US. The way that they deal with innovation is permissionless, right? So the legal framework actually take care of a lot of the things that in other countries would be in the jurisdiction of the regulator. So for an innovative company, they can go without a lot of friction from the regulator, but if they do make any, let's say, mistakes that should have been captured earlier, it will be captured by the legal framework, not the regulatory. So that gives them a lot of leeway in terms of how they can actually expand within that market. Here you have, in most of the world, you have to really convince the regulator to let you in, get in the sandbox, then sell in the way that the regulator thinks is possible. Luckily for Saudi and GCC in general, the regulator today is very aligned in terms of interests of the innovation ecosystem, and they want that to happen. But ultimately, we'll have to find a framework for how do we actually allow innovative companies to go without that kind of friction. That's one. The other thing is in terms of regulation and policy. For regulation, we already covered that, but policy is also becoming very different. We've seen a lot of support for startups, and that support was really necessary for the first phase of the ecosystem. Just get the ecosystem to launch on that learning curve. But now we need to change gears, because if we don't, what's happening today, that support is going into mostly funding, and that is inflating the valuations of many of these startups without having the proper cash flow engines on the other end to justify that increase. And what we're advocating for as VCs, at least what I'm advocating for, we need to shift that capital from funding into procurement, into partnering with those startups so that it shows up in their cash flows, not on their cap table.
So they become true scale-ups. So
exactly, and that is impacting our valuations as well. How do I value a company where I know they are alive and they are growing because of, not because of the market, but because of artificial policy that will probably disappear in a couple of years? And I think that is already, I'm seeing it with the policymakers today. They're realizing that, yes, we need to shift to the next phase of the growth of the ecosystem, and we have to update our valuations accordingly as well.
Great stage at FII to call out to the regulators. I'm sure some of them are listening, so we'll have, it's a perfect part. On that note, Rasha, let me come to you. Usually when I have LPs that I engage with, I ask them for their wish list. So, because I have the opportunity to then take it to the GPs as well. So what is your future wish list in terms of what you would like to see more of, maybe less of?
Yeah.
So what would be on your list?
I would say transparency, transparency, transparency. And maybe it's good to highlight here Jada's effort on that aspect. So we had a couple of initiatives. We worked with our GPs, and maybe the first one is the white paper, and thank you, Professor Claudia, for that well-written report. The second initiative is that we worked with our GPs to assess their valuation policies and came up with tailored set of recommendations to review their valuation policy for each fund. And the third initiative was to have a standardized valuation framework that outlines the valuation methodologies that can be used, allowing for some flexibility while maintaining the core principles. And these were the efforts that we've done at Jada.
Right. I mean, particularly also because naturally, given how long you were one of the first ones to deploy, you had a lot of emerging managers, particularly. So I assume there was a significant amount of hand-holding to be done.
Exactly, exactly. And also we're seeing a lot of international investors coming into the region. So I think it's very important to uplift the standards of valuation so more FDI can follow.
Yeah. Uplift standard of the managers, uplift the founders and the startups to move in the right direction. Which gets me to an interesting, we have another just about 10 minutes left, Michael, exits. So obviously, we have a story to tell from Southeast Asia on that as well, but exit strategies in MENA. So what could you envision, and maybe take some parallels from what we've seen in Southeast Asia? where we're probably about 10 years ahead of the ecosystem here.
Yeah, I could spend 5 hours spending on
I'm
exits,
sure.
but we'll keep it to a few minutes. I think if I look at our history, and we've seen all different exits, we've seen IPOs in our portfolio, we've seen, of course, secondaries, we've seen full M&A, we've seen partial M&A, we've seen hostile M&A, we've seen friendly M&A, we've seen the entire gambit. In all of these exit scenarios, the one thing that I've noticed was a very collaborative cap table. We noticed that for the founder itself, an exit is either a momentum where they are growing into a new phase. You can think of an IPO. I mean, it's the end for some of the investors, but it's just a phase for the founder because they still continue running the company. But if you finish to look at M&A, we've had instances where you have differences of opinion on who should be buying the company, when they are buying the company, and obviously at what price, because everyone has a different dynamic in terms of their return expectations. So what we've learned is that exits outside of the US and maybe outside of Europe means it's a lot of work for everyone on the cap table, for every single person. For the investors, they do a lot of work with the founders. It is aligning. It is working on expectations with the LPs, where they're asking, why are you selling now and not waiting to their IPO that has been planning for the next 2 years? So the thing that we've learned really is for each and every company, be very honest about what your exit expectation is, what your horizon looks like. We've had one example where a e-commerce company out of Singapore, they worked with an external advisor, a boutique investment bank, to run their process. And at some point, the founder reached out to us and said, Mike, this bank has no idea what they're doing. They don't understand our product. They don't understand it took 15 years of my life to build this company, and they're giving it away for almost peanuts. So we went back and said, you know what? We went back to the cap table and said, let's get together and work with the founder on an exit strategy for this specific company. So we fired the banker. I won't mention their name. We fired the banker and said, let's work as a group to a successful exit. They got acquired by a Korean company eventually. I met the founder, by the way, 2 weeks ago. Very happy. He's happy having a new partner on his cap table. For the investors, it was a good outcome. This was like an ideal scenario in the end, but I realized it takes a lot of work from both the founders and the managers, the investors, to make this exit actually happen. I foresee the same will happen here. I don't think exits are going to be easy. They're very, very doable. I do think that within the Saudi context, and now a very, very sort of open exchange that is willing to take on startups. So I think that's going to be an accelerator for the entire region. But I still think that from a manager perspective, it's going to be work, hand-holding, and aligning expectations.
Yeah, I would argue that I'm hopeful that it will go faster here, because I think one of the mistakes made in Southeast Asia was the lack of work on the exchange side.
Yeah.
We could have done an earlier step in the exchange direction. We had conversations about this before, and we're now paying the price for that.
Absolutely.
Right?
Yeah.
So,
yeah,
which,
maybe to give context for the audience. So if you look at Southeast Asia, there are a few exchanges that are active in terms of listings. So that's Singapore, Indonesia, Thailand, and Hong Kong. I think Hong Kong obviously stepped up because of their relationship with China, but Singapore had the opportunity to be the major hub exchange.
Yep.
Unfortunately, that didn't happen.
that has not transpired. And we're in the region in general lacking basically a decent exchange to kind of go IPO on, right? So that's the message also to the gentlemen at the exchange here that are managing that, which is very close to my heart in terms of exits. Now, maybe one final comment very quickly. You have a very diverse investor base as well.
Yeah.
So the whole thinking around exits, does that change depending on whether you have many local investors, international investors? How does that, for example, change your behavior?
Goodness. Yeah, I speak to a lot of emerging managers where there's a conversation around what should my LP base look like. We've been very fortunate of having LPs from this region, Japan, Korea, Southeast Asia, Europe, and the US. And that has really mainly helped our portfolio companies. If you have like a large automotive manufacturer on your cap table as an LP, I mean, they can help with robotics, logistics and supply chain, any company within the EV space. So it's really helpful to bring that knowledge to the portfolio companies. And even with exits, they can eventually be the buyers of your companies.
Of
So
course.
having a diverse LP base is very important. It's
Yeah.
very attractive to take a very big check from one LP. But again, I'm a bit older, so I can say this. I really encourage managers to take in a diverse LP base.
Yeah. Do you want to comment quickly on exits? Thoughts around exits in the region? How do you, when you look forward, where do you see the region to go?
Right, because it's a conveyor belt, right? And
It is.
if exits don't happen, then we will, get impacted negatively in the early stage investments as well. LPs care about DPI at the end of the day. So I agree. I mean, this is why we care about, what I mentioned about the companies going global, having a large TAM, believing in the team. Other than that, you'll be putting your fate in a single market where you don't know what's going to happen, really. It's a very volatile kind of environment across MENA, and still, even if it's stable, maybe not big enough. So one way we mitigated this risk of exits is, we want to make sure we invest in global companies, also very disruptive in terms of we are always going to invest in the cutting edge. Disruptive technologies. You won't see us investing in regular SaaS or marketplaces or other they're good businesses, but they're not good enough for venture scale kind of returns that we want to ensure the exits that we want also. And making sure that we have a very collaborative relationship, like Michael said, with our cap table, but also other stakeholders, corporates that might be doing acquisitions, regulators who are responsible for IPO regulation, even international players who want to come in and perhaps do this. I'll just end this with a quick example. One thing we did was we borrowed the idea of request for startups from YC, Y Combinator, and we applied it to partnerships with corporates around Saudi Arabia. One thing we did, for example, the Uniphonic, a SoftBank investment that they got $100 million in their Series B, is they have huge pressure to grow. And that growth is going to come organically and inorganically. So we knocked on their door. Hey, Ahmed Hassan, we know you have some strategic growth plans that startups could be good for them. Let's see what kind of problems you have on your growth strategy. We'll pick the ones for you that are actually more suited for startups to work on, and give us access to some of your assets, your client base, your distribution, some of your data, under some governance, right? And let's do this request for startups for 3 or 4 problems that startups can actually add value. Either they're going to be clients of yours, maybe partners, or maybe acquisition targets for you.
Absolutely.
And Uniphonic really did that, and we applied the program for months. And now they really like the program. They launched their own program called the Uniphonic X with 100 million riyals. And we want to do this across different sectors to stimulate that kind of demand from the market, whether it's acquisition or just regular buying.
So let me just say thank you very much. So Rasha, Michael, Waleed, for joining me on a panel that's not an easy topic, okay? So it doesn't lend itself very, very easily to that. So thank you very much all for listening. We should be able to put the QR code up if you would like to download a copy of the report. And any one of you, again, I invite all the funds as well as the LPs in the room to reach out to us. We will continue to publish a steady stream of research around the region and hopefully over time write the book on how the region rose. Thank you very much.
Thank you.
Thanks for having me.